Hey everyone, welcome back to the channel. So today I want to tackle a question that comes up constantly, especially for people who are earlier in their financial journey. Should I be saving my money or investing it? And the honest answer is that it's not really an either-or question. Both saving and investing have specific roles to play in a healthy financial life. The real question is, which one should you be focused on right now given where you actually are? So today I'm going to break down exactly what saving and investing each do, how they're different, when you should prioritize one over the other, and how to know when you're ready to make the transition from primarily saving to actively investing. Let's get into it. Let's start with the basics because I think a clear definition of each actually matters here. Saving is putting money aside regularly in a stable, accessible account. A savings account, a high-yield savings account, a money market account. The money is safe, it's liquid, meaning you can access it quickly without penalty, and it earns a modest guaranteed return. Saving is the foundation. It's what protects you from financial emergencies and what funds the near-term goals in your life. Investing is taking money and putting it to work in assets that have the potential to grow significantly over time. Stocks, bonds, mutual funds, index funds, real estate. The potential returns are much higher than savings. The historical average return of the stock market is around 7% annually after inflation. But unlike a savings account, investments can go down in value. You can lose money. And that distinction matters enormously depending on what the money is for and when you might need it. Both are necessary. Neither one alone is enough. The question is about sequencing and proportion. How much of your focus and your money should be going to each one at your current stage? So when should you prioritize saving over investing? The answer is until you have your financial foundation in place. And there are three pillars to that foundation. First pillar, eliminate high-interest debt. If you're carrying credit card balances at 20% interest, investing in the stock market at a 7% average return is mathematically backwards. You're earning 7 while losing 20. Every dollar you put toward eliminating high-interest debt delivers a guaranteed return equal to the interest rate you eliminate. Nothing in investing comes close to that on a guaranteed basis. Now, the nuance here is that this applies specifically to high-interest debt. Low-interest debt, a mortgage, a student loan at 3 or 4%, is a different conversation. When your debt rate is low enough that historical investment returns would likely exceed it, the math starts to favor investing alongside the debt rather than waiting to pay it off entirely. Second pillar, build your emergency fund. Before you invest seriously, you need 3 to 6 months of living expenses in a liquid, accessible account. Here's why this matters for investing specifically. Markets go up and down, sometimes significantly and sometimes quickly. If you don't have an emergency fund and something unexpected happens, job loss, medical expense, major car repair, you may be forced to sell your investments at exactly the wrong moment to cover the expense. You lock in losses and miss the recovery. An emergency fund is what allows you to stay invested through volatility instead of being forced out of the market by life circumstances. Third pillar, have a budget that consistently spends less than you earn. This sounds obvious, but it's genuinely foundational. You cannot build wealth through saving or investing if you're spending everything you make or more than you make. The gap between your income and your expenses is the raw material of wealth building. No investment strategy compensates for the absence of that gap. Once those foundations are in place, when should you start investing and what should you invest in? The answer to when is as soon as the foundation exists because time is the most powerful variable in investing. The earlier you start, the more time compound growth has to work in your favor. We've talked about this math in previous videos, but it bears repeating. The difference in wealth between someone who starts investing at 25 versus 35 using identical contributions and identical returns is staggering. Not because of how much more they contribute, but because of how many more years compound growth has to multiply those contributions. For most people, the best place to start is a retirement account, a 401k if your employer offers one, especially if there's a match, and a Roth IRA for tax-free retirement growth. These accounts are specifically designed to make long-term investing tax efficient, and they should be your first investment destination in almost every situation. Beyond retirement accounts, broad diversification is the core principle. Mutual funds and index funds spread your investment across many different companies and sectors so that no single company failure can devastate your portfolio. A simple three-fund portfolio, a total U.S. stock market fund, an international fund, and a bond fund, gives most investors everything they need without unnecessary complexity. If you want to invest in individual stocks, the non-negotiable rule is diversification across companies and industries. Owning 5 different technology companies is not diversification. The whole sector can decline at the same time. True diversification means exposure across different sectors of the economy so that weakness in one area doesn't crater your entire portfolio. Real estate is another investment vehicle worth understanding. It can generate passive rental income and tends to appreciate over time, but it comes with significant complexity, upfront capital requirements, and ongoing management responsibilities that make it more suited to investors who are already building from a strong financial foundation rather than those just getting started. Let me give you a practical framework for thinking about how to allocate between saving and investing at different stages. Stage 1, you have high interest debt and minimal savings. 100% of your extra money after essential expenses goes to building a starter emergency fund of $1,000 and then aggressively paying down high interest debt. Investing is essentially on pause at this stage except for capturing any employer 401k match because that's an immediate guaranteed return that beats everything else. Stage 2, high interest debt is gone and you have a starter emergency fund. Now you're building your full emergency fund to 3 to 6 months of expenses while also starting to contribute more meaningfully to retirement accounts. The split depends on your specific situation, but you're actively doing both. Stage 3, emergency fund is fully funded and high interest debt is gone. Now the priority shifts toward maximizing your investment contributions. Full employer 401k match, max out your Roth IRA, then additional investment contributions beyond that. Saving continues for specific near-term goals, a down payment, a car, a major expense, but your long-term wealth building shifts predominantly to investing. A couple of important mindset points about investing that I want to make sure land clearly. Investing is a long-term strategy, not months, years, and decades. The investors who get hurt are almost always the ones who treat the stock market like a short-term savings account and panic when it drops. Markets have always recovered from every downturn in history, but they recover over years, not days. If you need money within 1 to 3 years, it should be in savings, not investments. If you won't need it for 10 or 20 years, it should be invested. And be patient with the early stages. When you first start investing, the numbers feel small. You're contributing $200 a month, and the portfolio is only worth a few $1,000s, and the fluctuations feel significant relative to what you've put in. Stick with it. There comes a point, usually after several years of consistent investing, where your investment returns start to exceed your contributions. Your wealth starts growing from the inside rather than just from what you're putting in. That's when the compound growth really becomes visible, and it's genuinely exciting to watch. All right, let's land this. Saving and investing are both essential, and they serve different purposes. Saving protects you, gives you stability and liquidity, and funds near-term goals. Investing grows your wealth over time and is how most people build the long-term financial security they're working toward. The right sequence matters. Get your financial foundation solid first. Eliminate high-interest debt. Build your emergency fund. Make sure you're spending less than you earn. Then shift your focus progressively toward maximizing your investment contributions and letting compound growth do the heavy lifting. And wherever you are in that process right now, even if you're at the very beginning, the most important thing is to start. Start saving, start building the foundation, and get yourself positioned to invest. Because the time you spend building that foundation is not wasted time. It's what makes the investing stage possible and sustainable when you get there. If this was helpful, drop a like and subscribe. Personal finance videos every single week. And tell me in the comments, where are you right now? Are you primarily in the saving stage, the transition stage, or are you actively investing? I read every comment and I'd love to know. I'll see you in the next one.